Okay, starting this back up, let's look at this example here. So here we have a company with a stock price of $50 per share, 3 million shares of common stock outstanding, 25 million preferred stock, 75 million debt, 40% tax rate. So we take our $50 stock price and multiply it by 3 million shares. We come up with the value of equity of 150 million, and you have the preferred and the debt already. So you come up with a total value of the firm of 250 million. Your weights are for equity 60%, for preferred 10%, and for debt 30%. So here for debt, the return is, or the before tax return is 10%. Preferred stock is 9%, and the common equity is 14%. So you're simply going to take your equity and your weight, the 60%, 0.6%, 0.60%, multiply that times 14%, and you're going to come up with 8.4%. You're going to add that to the 10%, or 0.1, multiply that times 9%, and you get 9%, or 0.9%. And for the debt, you're going to take the before tax effects and calculate the after tax cost of debt, or return on debt, which is the 0.3 times 10% times 1 minus 0.40, or 0.60. And so what you come up with there is 1.8%. So you add them up. 8.4% for your equity, cost of equity, or required return on equity, required return on preferred of 0.9%, and required return of 1.8% on after-tax debt. You come up with a WACC of 11.1%. And so WACC is the overall return the firm must earn on its existing assets to maintain the value of the stock. All right, some of the factors that influence a company's WACC: certainly market conditions, especially interest rates, tax rates, and certainly market risk premium. The firm's capital structure and dividend policy is going to influence the company's WACC. And of course, their investment policy as well. Firms with riskier projects generally have a higher WACC. So they go into this example on Eastman Chemical, and so you've got a lot of different information here. Notice they have a beta of 1.44%. information on dividends, industry-wide, sector-wide, S&P 500. So you have a couple of different betas. What you could do is ignore one and use the other, or you could just average them out. Your risk-free rate is going to be based upon your T-bill rate. Here, the T-bill rate is 0.05%. Market risk premium, as I indicated, the book is using an assumed market risk premium rate of 7%. And so if you use the CAPM or SML for determining the cost of equity, you simply take the risk-free rate of 0.05% and add that to the product of your market risk premium times the beta. Here we've averaged the two, so it's 1.37, and so the cost of equity is 9.64% using this formula. Now, if you use the dividend cash flow method, here we've got a stock price of 69.20%, 69.20 per share. The last dividend was 160, and the growth rate is 7.68%. So you'd take 1.60 as your last dividend, so that would be D0, and multiply that times 7.68 or 1.0768 and divide that into the stock price, and then you add the 0.0768, so you're going to come up with the cost of equity of 10.17. So if you compare that with this, it's a little bit higher, but not too much, higher. And again, what you could do is you could average the two. Here they take the 9.69, the 10.17, add them together and divide by 2 to come up with 9.93%. All right, here's some information on the bonds. And what they do here is they take the percentage of the total using the market value of the bonds. So that's the percentage of total there. So for that first one, market value 1,019.02, percentage of the total number of bonds is 15%. Take that 15% and multiply it by the yield to maturity, and depending on whether or not you're using again the book value, if you use the book value, it's 998 times 0.15, or excuse me, 998 times 16%, 0.16. What you come up with there is 22%, 0.22% there, the next to the last line to the right, or column to the right. Or if you use market value, the 1019, that would be 15% of the total. And so you would multiply that times 1.41%, and you get market values of 21%. So anyway, bottom line is Eastman's cost of debt, depending on what you use, if you use book value or market value, is either 3.12% or 3.15%. And they're pretty close, although I think the book indicates you should probably use the market values. All right, so capital structure weights here. You've got equity, 148.65 million times 69.20 per share, so 148.65 million is the number of shares outstanding. So they multiply that times the stock price of 69.20 to come up with a market value of the equity of $10.287 billion. Now the debt, what they've come up with is a figure of 6.853 billion. And that's based upon the market values, again, of the debt here, all the bonds that they have there in the middle. So total value is the sum of the two, and so total value is 17.140 billion. And of course, the 10.287, the equity portion is 60%, and the debt portion is 40%. Here, the tax rate is assumed to be 35%, and so to figure out the WACC of Eastman Chemical, you take the 60%, multiply that times the 9.84% that you've determined is the required return for equity, and add that to the 40% times 3.15% times 1 minus 35%, your tax rate. So it says, it's got a slash in there, but it should be 6.72%, not 6 divided into 72%. That looked weird. So that's 6.72% is the WACC for this company. And note here some things to consider. A firm's WACC reflects the risk of an average project undertaken by the firm. Average means the firm's current operations. And so, as long as you've got some project that is similar to what the company currently does, then you could use WACC because that's going to be an average risk, the risk of the firm's current operations. If you're trying to determine whether or not to replace an asset in the firm's current operations, since it's similar, if not the same, you could use the average risk of the firm's current operations as well. Note here also that different divisions or projects may have different risks, and the divisions or projects WACC should be adjusted to reflect the appropriate risk and capital structure. So here, what they're trying to show is what would happen if we use the WACC for all projects regardless of risk. And so here we have a company that assumes and takes all projects. Well, the WACC is 15%, and any projects that have a return greater than WACC are accepted, whereas any projects with a WACC less than 15% are rejected. But as shown in this case, these projects are not the riskiness of the projects are not considered. The riskiness is reflected in the project's beta. And so here we have two examples. We have project A with a beta of 0.60% and project B with a beta of 1.20%. As I indicated, companies and projects with betas of less than 1 are less risky than projects that have betas, projects and companies that have a beta that's between 1, greater than 1, and up to 2% or 2.0 beta. So here we have essentially a situation where you've got a return greater than 15%, the WACC, that if you just used the WACC as your guiding stick, you would accept that project, but it's essentially twice as risky as Project A, which has a return of 14%, but if you consider the fact that its beta is half as risky as Project A or Project B, you would probably take the less risk in return for a little less return. And so, again, using the SML type approach, project's required return is calculated using the SML and the project's beta. Adjusting for risk changes the decisions. And so here you've got project A, and the required return when considering beta is now 11.8%, which is below the WACC. And with B, because beta is greater than 1, you've got a required return that's greater than WACC now, and you would reject that project. So here's what that looks like on a graph. So if you use WACC, there's the possibility, and you don't adjust it for risk, there's the possibility that you can have a risk of incorrect rejection of projects. So that would be a situation like where we saw project A being rejected. Also, we saw the occurrence of incorrect acceptance, where we accepted B because the WACC was greater than 15%, but because it's more risky, the actual required return is 16.6% after considering the risk. All right, let's move to company evaluation with the WACC. No, they don't do that. Well, I thought they were going to do the company valuation, but never mind. All right, so that's it for Chapter 12.